Welcome. I am Maximiliano Allende. They say the market has no memory, but the bruises from the last 48 hours suggest otherwise. If you were watching the screens yesterday, you saw a landscape of calculated panic, the kind of synchronized sell-off we haven't witnessed in over a quarter. It was the worst bloodletting in more than 60 days, leaving investors wondering if the floor had finally dropped out. But this morning, the air feels different. Across the Asia-Pacific, we are seeing a defiant, if fragile, resurrection. The sea of red that dominated our monitors has been replaced by a tentative, flickering green. The broad Asian indices are clawing back, currently up 0.7%. But the real story, the one that feels like a glitch in the matrix, is the Kospi. Yesterday, South Korea's benchmark was the anchor dragging the region down. This morning, it has surged nearly 5%. It's as if the market woke up and decided that yesterday's trauma was nothing more than a fever dream. But in this business, dreams are expensive, and reality is often hidden in the data. Look at the S&P futures. We've just breached the 7,000 milestone, up 0.3% in early trading. This isn't just momentum, it's a reaction to a powerhouse of a manufacturing report coming out of the United States. We are seeing industrial activity hit levels we haven't touched since 2022. For those betting on a hard landing for the global economy, the data is currently screaming a very different message. And then there's the tech sector. After the closing bell, all eyes turned to Palantir. The stock's performance in extended trading is providing a massive adrenaline shot to the tech-heavy indices. It seems the appetite for intelligence-backed growth is far from satiated. But let's talk about the bedrock. Let's talk about the metals. Gold and silver were battered on Friday and Monday. It was a violent deleveraging that shook the confidence of even the most hardened bulls. However, as of 9 a.m. here in the Emirates, we are seeing a crucial stabilization. Gold has reclaimed a 3% gain from its lows. More importantly, both gold and silver appear to be defending their 50-day moving averages with absolute ferocity. Why does this matter? Because the 50-day moving average isn't just a line on a chart, it's a psychological barricade. As long as it holds, the long-term narrative of safe haven protection remains intact. We've seen the metals swing back above critical resistance levels, and while the volatility hasn't vanished, the blind panic phase seems to have transitioned into a calculated accumulation phase. Volatility has been the undisputed king of the last few days. We're living through a period where the unthinkable is becoming a weekly occurrence. One day, we're discussing the collapse of diplomatic channels. The next, we're witnessing record-breaking recoveries. As I look at the screens behind me, the color is green. But don't let the color fool you into complacency. The markets are regaining their footing, yes, but they are doing so on a landscape that is shifting beneath them. The question we must ask ourselves today isn't just, why is it going up, but who is pulling the levers behind the scenes? Because between the manufacturing highs in the West and the geopolitical shifts in the East, a new map of the global economy is being drawn. And today, we are going to trace every line. Stay with me. This is just the beginning. If you want to understand where the world is heading, stop looking at the speeches and start looking at the trade routes. Yesterday, a shockwave moved through the New Delhi-Washington corridor. Through a series of high-stakes communiques, it was revealed that the United States is set to slash tariffs on Indian goods to 18%, and in some sectors, potentially much lower. This isn't a gesture of goodwill, it's a cold, calculated transaction. The price of admission for India? A commitment from Prime Minister Narendra Modi to cease the purchase of Russian crude oil. For the last 2 years, India has been a master of strategic autonomy, buying discounted Russian oil to fuel its massive internal growth while maintaining its status as a key Western ally. But the wind has shifted. In the world of Maximiliano Allende, we don't look at the morality of these moves, we look at the mechanics.
India is currently an economic paradox. On one hand, it's an engine of growth, boasting a GDP expansion of 7.2%, with some analysts at Bloomberg suggesting it could touch 7.4%. On the other hand, the Indian rupee has been battered, performing as one of the weakest currencies in Asia over the past year. High tariffs and capital outflows have created a pressure cooker for the Modi administration. By striking this deal, India is choosing market access over energy discounts. Think about the math. Trump's Truth Social announcements suggested a rollback of reciprocal tariffs from 25% down to significantly lower levels, and more importantly, the removal of punitive 25% sanctions that were specifically designed to penalize New Delhi for its energy ties with Moscow. For the Indian manufacturing sector, this is a massive green light. For the global oil market, it's a seismic shift. However, as with all things in high-level diplomacy, the devil is in the ambiguity. Just last week, the Indian oil minister was adamant that purchases of Russian crude would continue, albeit at a slower pace. Now we see a public declaration of a total pivot. Is this a complete decoupling from Moscow, or is it a rebranding of energy flows? India has already invested over $500 billion into its energy and metals infrastructure. They aren't just looking for cheap oil, they are looking for long-term energy security. If they stop buying from Russia, they must fill that vacuum, and that vacuum will likely be filled by American LNG and Middle Eastern crude, further cementing the US dollar's role in global energy trade. This is transactional realism at its finest. Trump is using the carrot of the American consumer market to dismantle Russia's energy revenue streams. Modi is using the sacrifice of Russian discounts to protect the rupee and give Indian exporters a fighting chance in the West. The reaction in the markets today tells the story. Indian equities are breathing a sigh of relief. The currency is finding its footing. But the question remains, can a nation as large as India truly flip a switch on its energy supply overnight without causing internal inflation? And more importantly, how will Moscow react when its largest neutral customer decides the price of friendship has become too high? We are seeing a reordering of the global hierarchy. The US and India are signaling that in this new era, trade is the ultimate weapon of war. But as we move from the oil fields of India to the nuclear shadows of Iran, we see that not every deal is signed with a handshake. Some are signed with a warning. From the trade corridors of New Delhi, we move into a much darker, more volatile corner of the global map, the nuclear shadows of Tehran. In the world of finance, we often say that geopolitics is noise until it hits the price of oil. Well, the noise just became deafening. As of 9 a.m. here in the United Arab Emirates, the whispers of a diplomatic breakthrough are sending ripples through the energy markets. The headline is clear. Iranian officials are reportedly preparing to sit down for a fresh round of nuclear negotiations. The location? Turkey, a traditional bridge between the East and the West. The participants? High-ranking officials from Tehran, Washington, and Ankara. But this isn't the diplomacy of the past. This is diplomacy under the shadow of an ultimatum. Donald Trump's rhetoric has never been subtle, but his latest warning that bad things await Iran if a deal isn't struck is being viewed by the markets as the ultimate maximalist pressure tactic. In my view, this isn't just a threat of kinetic action, it's a threat of total economic erasure. But why now? Why is Iran, a nation that has spent years projecting defiance, suddenly showing a willingness to return to the table? To understand the why, you have to look at the weakness. For decades, Iran's regional strategy was built on a ring of fire, a network of proxy forces that allowed them to project power without a direct confrontation. But look at the board today. Those proxies have been severely degraded. From the Levant to the Red Sea, the infrastructure of Iranian influence is being dismantled. Simultaneously, the Iranian economy is gasping for air. The rial is in a tailspin, and the internal pressure on the leadership has reached a breaking point. Desperation is a powerful motivator at the bargaining table. When you have no more proxies to fight your wars and no more money to feed your people, diplomacy stops being an option and starts being a necessity. The market is already front-running the possibility of a deal. Look at the price of Brent crude, down 0.4% this morning, following a sharp drop yesterday. The war premium is being bled out of the price of oil. But here is the catch. The Trump administration isn't just looking for a nuclear deal 2.0, they're pushing for what we call a grand bargain. This would involve not just the freezing of uranium enrichment, but a total dismantling of Iran's ballistic missile program and a permanent cessation of funding for regional militias. Is that a bridge too far for the supreme leader? Or has the cost of resistance finally exceeded the benefit of the status quo? We're also seeing a flurry of quiet diplomacy from the Gulf capitals. Their message to Washington is simple: try the diplomatic route first. They know that if these talks fail, the bad things Trump mentioned could ignite a regional conflagration that no one, not the oil markets and certainly not the global economy, is prepared for. As we watch these talks unfold in Turkey this weekend, remember, this isn't just about centrifuges and inspections. It's about whether Iran can be reintegrated into a world that has moved on without them, or whether they will remain a pariah state under the weight of bad things. The volatility is far from over, because while the diplomats talk, the bankers are already calculating the cost of failure. And speaking of calculations, we need to go back to the heart of the global machine. We need to look at the Federal Reserve, the U.S. manufacturing boom, and the man who might be about to change the rules of the game for every investor watching this channel.
Let's step away from the geopolitical theater for a moment and move into the engine room of the global financial machine. We are standing at a milestone that just a few years ago would have been dismissed as a fantasy. The S&P 500 has officially crossed the 7,000-point threshold. But don't just look at the number, look at how we are reacting to it. In political science, there's a concept known as the Overton window, the range of ideas tolerated in public discourse at any given time. In the world of finance, this window is shifting at terminal velocity. Volatility that would have triggered a mass exodus in 2019 is now dismissed as just another Monday. We have become desensitized to chaos, and this desensitization is fundamentally re-engineering how we value assets. Maximiliano, why is the market euphoric despite the constant drumbeat of recession warnings? The answer is buried in the latest U.S. manufacturing data. We have just witnessed the strongest industrial expansion since 2022. This isn't just a statistic, it's a direct refutation of the hard landing theorists. The data suggests that the American industrial heart is beating faster than anyone predicted. However, this euphoria is masking a tectonic shift in the operating system of the U.S. economy. Let's talk about Kevin Warsh, the man currently touted as the potential successor to lead the Federal Reserve. Warsh is not your traditional central banker. He is a vocal critic of the Fed's bloated balance sheet. He believes the Fed has become too large, too intrusive, and has distorted the very market signals it's supposed to protect. For a decade, investors have lived under the Fed put, the ironclad belief that the central bank would always deploy a safety net by printing money whenever the market stumbled. But in the era of Warsh, or a government following a similar doctrine, that net might be retracted. If Warsh takes the helm, we could enter the era of true quantitative tightening. The question we must ask is, can the stock market stand on its own feet when the crutch of cheap liquidity is finally removed? But here is the detail most analysts are missing. Power is shifting from the Federal Reserve to the U.S. Treasury. Since the tenure of Janet Yellen, we have seen the Treasury take a much more active role in managing the yield curve through bond buybacks and strategic debt issuance. This is what we call fiscal dominance. We are no longer just dependent on the Fed's interest rate hikes or cuts. We are living in a world where the Treasury is pulling the levers of liquidity. It is a fusion of fiscal and monetary policy that we haven't seen in the modern era. So, how do you navigate this? Many are betting on the steepener trade, predicting the yield curve will normalize with a sharp upward slope. But I have a different view. Don't get distracted by the extreme ends of the curve, the 2 years or the 30 years.
Look at the belly of the curve, the intermediate 5 to 10-year notes. This is where the risk-to-reward ratio is most balanced, as long-term yields remain under pressure from a staggering national debt. I want to issue a warning. There is a profound disconnect between financial valuations and the real economy. The S&P 500 at 7,000 is a triumph, but it is also a burden. When bank stocks and tech giants reach extreme valuations, we have to ask how much of this is genuine growth and how much of it is an illusion fueled by residual liquidity. The time has come for sophisticated investors to consider a rotation from pure equities into high-quality credit instruments. Reliable income streams are becoming far more attractive than the hollow promises of infinite growth. We are living in an era where the old rulebooks have been incinerated. Volatility is no longer a risk, it is the new habitat. And to survive, you cannot look at the market through the lens of yesterday. Next, we turn our gaze across the Pacific to a powerhouse that is moving in direct opposition to the rest of the world. Australia, South Korea, and the unpredictable waves of the Asian markets. Let's go deeper.
While the Western world is obsessed with the timing of the next interest rate cut, a rogue actor has emerged in the Southern Hemisphere. The Reserve Bank of Australia, or the RBA, has just sent a shockwave through the global banking system. In a move that defies the current global trend of monetary easing, they have hiked their key interest rate by 25 basis points. This makes the RBA the first major central bank to initiate a tightening cycle this year. To many, this felt like a cold shower. Just 6 months ago, the narrative in Sydney was about the end of the hiking cycle. Today, that narrative has been incinerated. Why would they do this? Why move in direct opposition to the Federal Reserve or the ECB? The answer is a brutal piece of honesty from Governor Michelle Bullock. She described the current inflation levels as unacceptable. In her view, the road back to the target inflation rate is taking too long, and for the RBA, the risk of doing too little far outweighs the risk of doing too much. This isn't just a local story. When a major central bank bucks the trend, it forces every global macro fund to reevaluate their positions. We are seeing a massive sell-off in the Australian bond market, with analysts now predicting that yields could touch the 5% mark by the end of the year. For the average Australian homeowner, this is a bitter pill, but for the global currency trader, it's a siren song. The Australian dollar is no longer just a commodity currency, it is becoming a yield play. But the Pacific ripples don't stop in Sydney. Let's look north to Seoul. If yesterday was a nightmare for the South Korean markets, today is the ultimate V-shaped recovery. The Kospi, which was the laughingstock of the region just 24 hours ago, has exploded. At one point in the session, it was up nearly 6%. This isn't just a dead cat bounce, this is a massive inflow of capital back into the heart of the global technology supply chain. As I mentioned earlier, the manufacturing data from the US is strong, and who builds the components for that industrial boom? South Korea. When the S&P 500 pushes towards 7,000, the Kospi acts as its shadow. The recovery we are seeing today is the market's way of saying that the panic of the last 48 hours was overdone. It was a liquidation event that has now cleared the way for a more rational accumulation. We are also seeing a rare moment of strength for the Indian rupee. As we discussed in Part 2, the trade deal with the US has provided a safety net for a currency that has been under siege for a year. The removal of punitive sanctions and the reduction of reciprocal tariffs aren't just trade policy, they are currency support mechanisms. So, what is the takeaway here? The takeaway is that global synchronicity is dead. We are moving into a period of extreme divergence. Australia is tightening, China is grappling with tech taxes, India is pivoting its energy base, and South Korea is riding the wave of US industrial demand. As an investor, you can no longer buy Asia as a single block. You have to be surgical. You have to look for the anomalies, like the RBA, because that is where the real price discovery is happening.
The world is fragmenting, and in that fragmentation, there is immense opportunity for those who aren't afraid to look where everyone else is turning away. But as the markets in Asia stabilize, a new kind of disruption is brewing in the hangars of Texas and the data centers of the future. We are about to go beyond the atmosphere.
If you believe that a 7,000-point S&P index is the ultimate horizon of wealth, you are looking at the wrong map. While the bankers in New York and London are fighting over basis points, the very definition of infrastructure is being launched into orbit. Let's talk about the man who remains the most disruptive force in capital markets today, Elon Musk. Through a series of strategic maneuvers that have just been confirmed, SpaceX, the undisputed crown jewel of the Musk empire, has officially absorbed xAI, his artificial intelligence startup. It isn't just a merger of two companies, it is the birth of a titan. The combined entity is now valued at a staggering $1.25 trillion. To give you some perspective, this single private entity is now worth more than most of the world's national stock exchanges. But why merge a rocket company with an AI lab? Musk himself described this as the most ambitious vertical innovation drive on and off the Earth. In the world of Maximiliano Allende, we look past the hype and focus on the architecture. xAI is a cash-hungry beast, burning nearly $1 billion a month in its race to achieve artificial general intelligence. By folding it into the massive cash flow positive infrastructure of SpaceX, Musk is securing the brain for his body. But the real disruption, it's not just about software, it's about where that software lives. There is a growing vision, one that Musk is now leading, of moving data centers off-planet. Why? Because on Earth, data centers are limited by land, cooling costs, and energy regulations. In space, you have 24/7 access to high-intensity solar power and a natural cooling environment that approaches absolute zero. The goal is to put the cloud literally in the clouds, or rather above them. Imagine a world where the most powerful AI computations are happening in orbit, beamed down via Starlink with zero terrestrial latency. This is the ultimate vertical integration. SpaceX builds the rockets, Starlink provides the network, and xAI provides the intelligence. However, let's be clear, the risks are as vast as the vacuum of space. Cosmic radiation can fry electronics, and the cost of maintaining a server farm in orbit is astronomical. But in the race for AI supremacy, Musk is betting that the high ground, the literal high ground of Earth's orbit, is the only ground that matters. But while one hand reaches for the stars, the other is being slapped by the cold hand of regulation. In a move that caught the automotive world by surprise, China has officially become the first nation to ban hidden door handles on electric vehicles. This design, popularized by Tesla and copied by almost every high-end EV maker from Xiaomi to BYD, is now being labeled a safety hazard. After several high-profile accidents, including 2 incidents where Xiaomi cars caught fire and the electronic doors refused to open, the Chinese government has stepped in. Starting January 1st of next year, every vehicle sold in the world's largest EV market must have a mechanical override accessible from the outside. This is the regulatory friction that no amount of AI can solve. It's a reminder that even as we build trillion-dollar empires in the sky, we are still governed by the physical laws of safety and the political laws of the state. For Tesla, this means a significant re-engineering of their production lines for the Chinese market. It's a small detail with massive implications for the global supply chain. We are living in a duality. On one side, we have the Musk ascendancy, pushing the boundaries of what is humanly possible. On the other, we have a world that is becoming increasingly cautious about the frictionless future we've been promised. But if you think the drama is limited to the giants, you haven't been watching the frontier markets. As the titans clash, the silent rise of the global south is beginning to change the balance of power. Let's talk about Namfi, Kenya, and the new money flowing into the heart of Africa. While the headlines are obsessed with the S&P 7000 and the high-tech dramas of the Silicon Valley elite, a much quieter, more fundamental shift is happening in the global south.
In the world of Maximiliano Allende, we don't look for the noise, we look for the arbitrage. And right now, the greatest arbitrage in the world is the gap between the perceived risk of Africa and its actual structural evolution. Let's start with South Africa. For years, South Africa was the sick man of the emerging markets, hobbled by energy crises and logistical bottlenecks. But look at the data coming out this morning. Capital investment into the country is witnessing an explosion. Business commitments from the private sector have tripled in the last year alone. This is a structural metamorphosis. While government-led projects are declining, private capital is rushing in to fill the vacuum. Why? Because the reforms in energy and logistics are finally starting to bite. Investors aren't just betting on South Africa's resources, they're betting on its efficiency. We are seeing a move toward private-public convergence. When the state fails to provide infrastructure, the private sector builds its own. This creates a more resilient, albeit more expensive, foundation for growth. With inflation stabilizing and interest rates poised to soften, South Africa is no longer just a metals play, it's a recovery play. Maximiliano. But if you want to see the future of global finance, you have to look at Kenya. Kenya has just pulled off a masterstroke of currency pragmatism. In a move to manage its suffocating debt levels, Nairobi has successfully reduced its debt repayments to China by over a third. How? By switching the settlement currency from the US dollar to the Chinese yuan. This is de-dollarization in its most practical form. Last year, Kenya and China agreed to convert $5 billion worth of debt into yuan-denominated bonds. By removing the greenback middleman, Kenya has slashed its exchange rate risk and eased the pressure on its internal economy. It's a lesson in pragmatic sovereignty. When the cost of the dollar becomes too high, the world doesn't stop trading, it just changes the currency of the trade. Maximiliano. And then we have the new creditors. Nigeria, the giant of Africa, is seeing a new kind of capital inflow. The United Arab Emirates, the world's most aggressive liquidity provider, is moving in where Western banks have retreated. The UAE's largest lender is set to open its first sub-Saharan branch in Nigeria this year. This isn't just about banking, it's about strategic corridors. The UAE is looking to facilitate trade between the Middle East and Africa, positioning itself as the central hub for the next decade of frontier growth. For Nigeria, this provides a desperate lifeline of foreign capital and a bridge to the wealthy markets of the Gulf. What does this tell us? It tells us that the unipolar financial world is dead. In South Africa, the private sector is taking over the role of the state. In Kenya, the yuan is challenging the dollar for debt supremacy. In Nigeria, Middle Eastern capital is replacing Western influence. The frontiers are no longer on the periphery, they're becoming the laboratory for the new global order. But as we look at these emerging powers, we cannot ignore the original power of the Middle East. One kingdom is currently undergoing a transformation so vast it threatens to rewrite the rules of global investment forever. We are going to Riyadh, and we are going to look at the final vision.
We have traveled from the recovery in Seoul to the manufacturing floors of America, from the oil deals in New Delhi to the orbital ambitions of Elon Musk. But our journey ends where the future is being built with brute financial force, the kingdom of Saudi Arabia. If you want to see the ultimate pivot, look at Riyadh. Under the leadership of Crown Prince Mohammed bin Salman, the kingdom isn't just diversifying its economy, it is re-engineering its DNA. In recent months, we have seen a barrage of reforms that were unthinkable just 5 years ago. They are opening their massive copper mining sectors to foreign giants. They are freezing rents to protect the workforce. They are even adjusting long-standing social regulations, all with one singular, cold-blooded goal: to make Saudi Arabia the most competitive investment destination on the planet. But here is the holy grail for global fund managers. Currently, foreign ownership of Saudi-listed companies is capped at 49%, but our sources on the ground and the Capital Market Authority itself have confirmed that a radical review is underway.
By 2026, we could see those limits smashed, whether it moves to 55%, 70%, or total liberalization. The message is clear. The kingdom is no longer a closed shop. It is an open arena. They are moving from oil wealth to institutional wealth. They want your capital, but more importantly, they want your presence. As we look at the board today, the world seems like a chaotic puzzle. We see the S&P 500 defying gravity at 7,000. We see gold and silver defending their ground like ancient fortresses. We see India trading Russian oil for American market access. We see Kenya abandoning the dollar for the yuan. To the untrained eye, this is noise. To the subscriber of Maximiliano Allende, this is a symphony. Every piece of news we have discussed today is connected by a single thread, the search for stability in an era of permanent transition. The old world of predictable cycles is dead. We have entered the era of the grand divergence. I want to take a moment to speak to you directly. We spend so much time talking about charts, percentages, and geopolitical maneuvers, but at the end of the day, why do we do this? Why do we obsess over the Overton window or the belly of the yield curve? It's not just about the money, it's about clarity. In a world that is designed to keep you distracted, confused, and fearful, knowledge is the only true hedge against inflation. The most valuable asset you own isn't sitting in a brokerage account or a gold vault. It is the 3 pounds of gray matter between your ears. The lesson of today's market, the lesson of the Kospi's 6% surge and the RBA's rogue rate hike, is that resilience is a choice. You can choose to be a victim of the volatility, or you can choose to be its student. The world will tell you that the bad things Trump warned about are inevitable. I tell you that for the informed mind, there is no such thing as a crisis, only a repositioning. As I head down to the World Government Summit here in Dubai to speak with the leaders of IBM, Google DeepMind, and BYD, I carry one thought with me. The future doesn't belong to the loudest voice, it belongs to the one who can see the patterns in the chaos. Thank you for trusting me with your time today. It is the only resource we can never earn back. Keep your eyes on the horizon, keep your mind sharp, and never let the noise drown out your signal. I am Maximiliano Allende. This is our world. I'll see you in the next one.